Hey guys.
Good morning.
Good morning.
Morning.
How's everyone doing?
I'm a fall person, so I'm feeling this. This is good. It's like 50 degrees, sweater weather.
We've got blizzards on the plains. We've got I-80 shut down. We've got 20 tractor trailers blown over in the Ontario airport region yesterday with 90 mile an hour Santa Ana winds. So winter's back with a vengeance.
Always there with cheerful news. Thank you, Dean.
Yes. It's the bright side.
Yeah.
All right. So with that, we do have a special guest, and I want to leave a ton of room for questions at the end. So I'm going to get us started if you guys are all right with that.
We are.
Sound good?
Yep.
Go for it.
All right. Well, welcome everyone. This is our weekly DAT IQ market update. We are here every week sharing insights and data of what we're seeing in the market. I'm Ken Adamo, Chief of Analytics at DAT. And we're running a 50% PhD ratio this week because we have Dr. Ned Damon and Dr. Chris Caplice with us. Just as a refresher, Chris has been on with us before, but he is Chief Scientist at DAT, and he heads up the Center for Transportation and Logistics at MIT. We're also joined by Dean Croke, who is our Principal Industry Analyst. Welcome, guys.
Glad to be here.
Howdy.
Thank you.
All right, so we have a lot of interesting stuff to cover this week, but I'd be remiss if I didn't give a plug for Chris's podcast. It's the Freight Vine podcast, often featuring luminaries from both shippers, carriers, and brokers. It comes out every other week, right, Chris?
Yes, every other Thursday. It came out just last week.
Awesome. Who was last week's? I haven't caught that one yet.
It was Mark Brazeau from Head of Logistics at Fiat Chrysler of America. I always have to remember the FCA that Fiat bought Chrysler.
Yeah, for sure.
Mm-hmm.
Awesome.
Yeah, so
it's always great content.
Yeah, we're lined up for the fall with a couple great people coming up, so I encourage you to tune in.
Yeah, it's awesome. So I'm going to jump right into our key points for this week, and then we're going to get headed into the update from Dean. So spot rates are definitely plateauing. We're seeing that in the data. We're hearing that in our anecdotal evidence, just sort of plugging along. I'm not going to spoil at what level because we have to settle our bet here in a few minutes. Total load posts drop almost seasonally in line with 2017, which is something Dean's going to touch on in a bit here. Truck postings are starting to climb, typically an indication of capacity loosening a bit, probably seeing some of the less searching, more posting. And then pretty much all of the credible volume indicators in the market, whether that's ATA, FMIC, MSU, and even earlier CAS, would indicate volumes flat to down a little bit year over year. So with that, I'm going to turn it over to Dean to get us into the detail. Dean?
Thanks, Ken. Let's dive straight into the load board activity. The load to truck ratio for dry van. Driven by a couple of things, load posts dropped 4% last week in dry van, still up 132% year over year. So we're still in uncharted territory from a load post volume perspective. Truck posts increased 3%, so possible sign capacity is loosening. The combination of both load posts dropping and trucks posts increasing drove the load to truck ratio down to 3.97 last week. In the refrigerated sector, the load to truck ratio dropped further last week to 7.72. This was driven down by a 6% drop in reefer load posts, and they've been decreasing steadily for the last 5 weeks as produce season sort of works through its the fall season. On the flatbed side, flatbed load to truck ratio dropped also. There was a 5% drop in load posts last week and 6% increase in trucks posting. The seasonal comps are striking in terms of looking at 2017 numbers, although very different economies from a demand perspective. Shifting over to the market condition index for dry van, fast-moving consumer goods continue to dominate the freight market. The recent IRI report for CPG demand shows that volumes are up 8% year over year, but in e-commerce, CPG sales are up 34% year over year. And this is directly connected to the current surge in imports that the Journal of Commerce reported last week from China. They're arriving this week and the week after, as reported. And as a result, the top 2 West Coast markets on our market condition index in Los Angeles and Ontario both reported strong volume gains last week, up 25% and 19% respectively. Further north, some pretty big news this week. The Union Pacific Railroad announced a surcharge on intermodal freight for their contracted shippers. As a result, some of that volume moved over to the truckload market. In Seattle, volumes jumped 22% week over week, and outbound rates out of Seattle jumped 12 cents per mile. In the refrigerated sector, the market condition index, we're seeing some first reports of fall season vegetables coming out of Florida. We don't see a lot of activity normally in Florida this time of the year, but there's a lot of seasonal volume coming out. Miami volumes jumped 22% week over week. Jacksonville was also high, up 16%. For carriers and brokers, capacity is still very loose, though. It's still a strong backhaul market. Rates did move up, though, 5 cents to $1.38. The potato season up in Twin Falls is still pumping along. It's about 25% its way through the harvest. Volumes are up 20% week over week. So, but capacity is still tight there. Rates moved up 2 cents to $2.44 a mile. And the big market mover this week was the Winter Salad Bowl in Humor and the Imperial Valley in California. Volumes are up 54% month over month, and rates jumped 17%, so 17 cents to $2.29 a mile last week. So wrapping up with our dry van year over year spot rate review. As Ken said, spot rates plateaued last week around the $2.23 mark. They're still up 50% year over year, but there are definite signs rates are either cooling off as they normally do each season or possibly taking a pause before the final surge of holiday retail freight moves inland. On the refrigerated side, there's definite plateauing of reefer rates around the $2.38 per mile mark. That's definitely emerging. Looking back to the start of October, reefer rates haven't moved up or down by more than 1 cent per mile. But rates are definitely higher than last year. They're up about 62 cents per mile. This time last year, rates were only $1.76 compared to this week's $2.38. And wrapping up with flatbeds ended last week at $2.24, much the same as where they started. Since the start of October, they've been trading in a narrow 2 cents per mile band and definitely showing some signs of backing off the strong rate rise they've had since May. So that's it for this week's market update. And if you want to find out more about what's happening in freight, go to dat.com/resources and download the weekly market update. Over to you, Ned, for the rate forecast.
Before we do the rate forecast, I think we have something very important to settle, and that is Rate Watch 2020.
Ooh.
Yeah, no. As excited as I felt about that, Ken emerged victorious, both in absolute terms and in the terms of the bet, with van rates being $2.23 a mile. As a reminder, Dean, you had $2.10, I had $2.30, and Ken had $2.20, and we were operating under Price is Right rules. So that makes Ken the undisputed winner of Rate Watch 2020.
Well done.
So, Ned, do you happen to have where Raycast would have predicted it when we started? Because really that's the entire DAT motto, right? Don't guess, know.
I do happen to have that, and it looks like Raycast is predicting $2.20 a mile, just in line with you. It's almost as if you think that my forecasts are accurate. It's great.
I know. I mean,
I doubt
it's interesting, right? Because we saw. I'm trying to. It's a little small on my screen, but the models were in quite fervent disagreement at that point in time, right? I mean, there was a lot of top rates. So we were looking at the models, and if I think back, our discussions really centered around a friction point at that 225, which is kind of where I based my decision. I thought we would see a definite friction point, and it appears, and I'm not doing a victory lap here, but it does appear that 225 friction point is holding for dry vans right now.
No, absolutely. I was expecting much more of like the blended model forecast that was coming in at around 230 because the short term has been so predictive. But you're absolutely right, and winners get to win. So congratulations, Ken, on your victory.
Well, whenever there's winners, there's always losers. So I think you guys have to settle up this bet. And while you're doing that, Chris and I think are going to walk through what we don't have to do. While you guys go get changed in your costumes.
Do what you have to do.
All right, we'll see you in a minute, guys. So here's what I got from our producer, Monica. This is the second iteration. Apparently the first one was not corporate approved. At FedEx, that would mean anything. Basically, any fun on camera would not be corporate approved. Let's see here.
Are you literally taking out of the bag now, or is that just for prop?
I listen when the producer. Oh God. So this is Thor.
You should put it on. Does it come with a wig?
Does it come with the hammer? What's the hammer called? I'm not putting it on.
No.
What's the hammer called that he uses?
Hammer? I don't watch those movies. I have no idea.
I don't either. Ned'll know.
I'm sure he has a name. Someone knows. So I'll show you mine. I'm not going to blow it up, but it's full body.
What? Is it a Mr. Potato Head?
It is a Mr. Potato Head. With a fan, I could
I'm jealous.
Turn it on, but it only blows up if you have someone in it, apparently, which I will not be.
Oh, I'm jealous.
I can mail this to you.
How do you get a Thor costume with no hammer? Is this Thor or is this Iron Man? I don't even know.
Iron Man doesn't have hair.
Oh.
But the best thing, Ken, is my gloves. Now when I type, I can sound like Dean. Right?
This is classy.
All right. So I don't know what Ned has to do.
Well, Ned still seems to be getting ready. Chris, do you want to plug the event that you have coming up for folks?
Yes, sure. So up at MIT, as Ken said, I'm part of the Center for Transportation Logistics. I also created something called Freight Lab. It's been around for about 10 years, and we do projects with different companies, shippers, carriers, 3PLs, and we have events. And on 3 November, yes, Election Day, from 1 to 2:30 p.m. Eastern Time, we'll have an open webinar. And I'll be able to show you the link to that in a few minutes when we get to that slide. But it's open for free. It's registration. You just have to register for it. And I'm trying to get as many shippers, carriers, and brokers together because what we're going to talk about is transportation contracts. Is there a better way to do transportation contracting? Procurement, whether you do dedicated, some type of contract, or spot, how do you set that up? It should be an interesting talk. And so I encourage you to register for that, and we'll give you the link for that in just a few minutes.
Awesome. Yeah, I'm sure it'll be a great event. So right before, I still don't see Ned, but we actually have a question that I think you and I, Chris, are more than well equipped to handle. It's from El Medi, and I apologize if I mispronounced your name. But the question is, are our forecasting models built on machine learning algorithms? So you have the signal forecast.
Yeah.
And we have Raycast, right? So I'll answer for Raycast, and yes, it is built on machine learning algorithms that look at historical data, external variables and factors, and then predict out 5 different use cases of varying time lengths and contract versus spot to generate a rate. But what about the signal?
Yeah, we use a mix, same thing. And so any kind of machine learning algorithm right now has been thrown out of whack, right? Because they use historical patterns, and we're in an area that doesn't have many historical patterns. So we have a lot of exogenous variables as well. And part of the art and science here is the model is going to give you something, and you've got to look around and see, does this make sense? Because we're in a lot of unprecedented ground, and that's why a lot of models from other companies, we're finding this spot continuing to grow because that's what's been happening over the last period of time. And so it's kind of a balance between the art and the science when we do our forecasting. Yeah. But yes, we use machine learning. There's a lot of good techniques out there.
For sure. All right. Well, I see backstage we have the non-winners. I'll be a little politically correct, but let's bring them back.
Okay. I have no idea.
They allowed that one, but not my original costume?
Crocodile Dundee, come on, it's good, it's good.
Did you at least get a knife?
Well, that's not a knife, but that'll have to do.
Okay. Excellent.
Oh, goodness.
Ned, what are you?
What are you, Ned? A troll?
This very question. Yeah, so apparently there's been some troll movies that have come out, and there's a whole universe of troll characters. So
you're pretending not to know the troll movie.
Listen, I have my son is a train child, and we watch the Polar Express over and over and over because that movie is like 40% trains by volume.
Nice. Excellent. Yours doesn't look like a costume, Dean. You wear this most days.
Yeah. Yeah, I didn't think I'd have to have my Outback truck driving equipment back on so soon.
The necklace really sets it off. So
Yeah.
I think the most appropriate thing to do is for Ned to talk about what Raycast is predicting this week in full costume. I'd ask you to do it in character, but I don't know if you can pull off a Daniel Day-Lewis-esque troll performance.
I'm not willing to do that. I will say one downside is that the hair is interfering with my headphones, so I'm going to have to look like I'm getting a news announcement constantly.
Well, in all fairness, you didn't listen to Raycast a few weeks ago, so
you're not
there
wrong.
You go. Bringing it all back together. All right, let's talk about the forecast.
All right. So I'm going to start off by looking at the national spot forecast. So in blue is the Raycast model. And then over on the right, sorry, not in blue is the Raycast model. Sorry. Blue is the historical market rates observed by DAT. And then off to the right, we have the Raycast model along with a couple of other models that we use for forecasting. We've got the short-term model in red, the Raycast model in green, the blended forecast, two different versions of it, one in yellow and one in gray that are mixtures of the short-term and Raycast model in different amounts and in different ways. What I would say for this is you'll notice that it's very difficult to actually see where the forecasts disagree, and that makes me happy because that means that the models are in general agreement, and that looks good. It looks like basically all the signs are pointing towards flat going forward for the next period, which is, maybe not the most exciting thing, but I'd rather have flat than the kind of craziness of the market that it's been recently. Moving forward to the reefer rates, here we have actually a lot of model disagreements. So again, blue is the historical market rates observed by DAT. And then off to the right, you can see our models. One thing you'll notice is that the short-term model is shooting high. It's shooting high to where we actually are. So when we're running these forecasts, we don't just start the forecast on today. We start the forecast a little ways back and let it run forward as a way of sort of checking how the model is performing relative to recent data. And the short-term model still thinks that we're on a linear trend, basically continuing from, I'd say, like late August. So it's being depressed, but it's not depressed enough. And or I guess for the circumstances, it's not quite depressed enough. The Raycast model is much closer to what things are actually happening. And then you can see the blended forecasts are a little goofy because of that misalignment. Finally, we're moving on to the flatbed forecast, and you can see a similar sort of a pattern there where the Raycast model in green is predicting a little bit of a downturn and then a correction, which while the short-term model is still on trend from August, and the blended forecasts are kind of funny mixtures of those two. I would say that we're heading into a period where the Raycast model has been performing really well, and I would definitely be leaning more towards the Raycast model than other models. Of course, it's also hard to take me seriously when I'm wearing a giant purple wig and mustache, but those are the consequences of losing a bet. You gamble, you lose.
And before we move on, I just want to clarify because I know we've gotten this question before. Raycast is what's in all of our products. We use these other models as sort of, as Chris mentioned earlier, ways to see, just like we disagree, we can run different modeling techniques and see how they disagree. It can then really help inform our decisions about broader macro trends. At the end of the day, Raycast is still generating something around 6 million data points a day of forward-looking rates down to the, in some cases, the 3-digit zip level. So make no mistake, that's what's in all of our products. That's our rock hard, solid, production clad model.
Correct.
And these other ways are just, ways we analyze the market, right?
Yeah, absolutely. The short-term model was specifically introduced during COVID because we were seeing a lot more short-term behavior during especially the May and early summer period. But there's a reason why I don't pick that model for long or midterm forecasting. And that's, it's useful to look at, like you were saying, Chris, with having that kind of art of blending different modeling techniques and different exoges. Having that short-term in there is really helpful to figure out if there's some kind of a short-term trend. And it's particularly interesting when it diverges from the main model. But overall, the Raycast model is what we use and is our production model.
For sure. So do you want to tee up the question of the week?
Certainly.
Ed?
After I tee up the question of the week, I'm going to take off this wig so I can actually have the headphones sit on my head.
But keep the mustache.
I will keep the mustache. I honor my bets. All right. Ask IQ update. What are we seeing in the RFP market this fall?
Yeah, it's been an interesting market. And so a lot of shippers postponed their bids that they were planning to run in Q2 or Q3 because they thought the market would settle here. And so a lot of bids are being run in Q4 where they typically aren't run because it's a peak season for a lot of industries. And shippers are facing a really strange market. Monica, if you could go to the slide that I have. And this is a chart that's showing from 2017 on. If we get that up there, I can't tell if it's up.
One second.
Yeah. Okay. So what's happening is shippers are facing a stiff market. So they're seeing it kind of bifurcated between asset-based carriers and then non-asset-based or brokers or third parties. And what they're seeing is a general increase. We've seen the new rate differentials start creeping up over the last couple of weeks. And so this has been, it's still not at the year over year. It's just barely creeping over for contract rates year over year what it was last year. But we've seen a definite difference in the amount of rate increases we're seeing from non-asset-based versus asset-based. What this chart is showing in blue is the net increases across the market that we see for asset-based carriers, and that's around 7%. And then it's about 14% or double that for non-asset-based. And it kind of makes sense because non-asset-based providers have to buy on the spot generally, and so they're hedging their bets. So what shippers are facing right now is a choice. Do I stay with my non-asset-based carriers, which in a declining market, which 2019 was, is a good place to be because they tend to get rates below the average. In a rising market, it's just the opposite. So we're seeing shippers kind of ratchet away and turn the knob more to asset-based, a higher proportion of asset-based lanes and providers than non-asset-based. But it's a challenge what's happening because, as Dean, I think, said earlier, the net size of the market has not increased. It's very similar to year over year last year, but the big challenge is there's winners and losers, and this throws truckload market into a total frenzy because as I looked at the FMIC data with 100 or so shippers, and I looked how their year over year volumes were, half of them had positive and half of them had negative. So there are winners and losers. You can think of the industries, but also within industries. There's certain retailers that are booming, and on those lanes, their rates are going up because their volumes are up. And as you increase volumes disproportionately on a network, you're going to have spot rates because the assigned volume or capacity for that lane can't meet that new demand. And so all these trucks aren't totally fungible. What we're seeing is pockets of peaks and pockets where it's depressed. And that's what's driving a lot of the spot increase, in my opinion. But it's a crazy market, Ken. And so I don't know what you're seeing it from a slightly different side, but you're probably seeing some of the same things.
Yeah, I mean, we talk about it. It feels like almost like a broken record week in and week out, right? It's, we're seeing rates continue to be just astronomical coming off the coast. And I think the MCI map he shows illustrates it really well. You have to drive through a lot of dead freight. There's a ops engineer I used to work with who taught me a ton about freight, over the course of 7 or so years. He was a yellow roadway guy, and then sort of when the YRC thing went down, ended up coming over to FedEx. But basically saying, like, don't discount the areas you have to drive past. So if you're driving through an area that's hot, right, you're driving through opportunity to maybe take a couple shorter loads and maximize what we would call a tri-haul, a DAT. But when you're driving through just a dead area from LA to Chicago, for example, that's definitely going to have an impact on rates, and we're seeing it for sure. With the Seattle, what Dean, you said, rates decline. I'm gonna butcher this. Rates declined for 3 straight weeks in Seattle. UP announced the surcharge, and they were up how much?
I think it was about 22% up in volume, and rates were up about 12 cents a mile just in a period of a week.
Yeah, so I mean, these things definitely, these actions have consequences for sure. Chris, I was waiting for you to come on to ask you a question because we kind of tiptoe around it because I don't know if any of us have as much visibility to answer it with authority. But I mean, let's just say that you were out there trumpeting that rates were, volumes were up 30 to 50% using, I don't know, like tender data. What would cause that to show 30 to 50% up when pretty much every other major source is showing flat to down?
So if someone is seeing that significant increase, then they're only looking at a piece of the market, and they're probably My guess is they're hitting certain retail and certain CPG, because there are companies that, and we all know them, right? All the CPG for health or for safety or cleaning, they're booming. The same thing with packaged food. So it's almost like cherry picking the market. And that's why what we said when we looked across the whole market, there are winners and losers. And if all you do is talk to the winners, you're going to get a very different perspective.
Kind of as a follow-up, and I'm genuinely asking, this isn't kind of a dramatic question or a rhetorical question. How would you kind of carve up the market from like what percentage is electronically tendered? What portion is still kind of what I would call like the old school, whether it's email or phone call or dispatch through a TMS? Do you have any sense through your research or any of your students' research how that breaks out?
It's really segmented. And Dean, I'd love to get your opinion on this as well. You can segment the shippers by large and small. The large shippers, it's 90%. I mean, that's how they're processing it. It's the fastest way for them to do it. As you get to the smaller shippers, then it gets more manual. And I think the same thing, Dean, would you agree for carriers? They're going to have the larger carriers are going to have a more automated process, and the more sophisticated carriers, not just size, but the sophistication. As you get smaller, then it's more manual process. So in the market I see, it's 80 to 90%.
And the smaller carriers, the smaller they get, the more likely they are to have a handful of shippers from their hometown. So a lot of their freight is both, it's not necessarily tendered. It's a fairly informal process by either phone call or email. And so they sort of have contract freight on the way out, but they're the hometown carrier for those small shippers they've grown up with.
But would they have to use to get back though? Would they
use load boards to come back? Correct. Yep. Spot market to get back. Yep.
So just to kind of say that back from my own understanding, if you're looking at EDI, electronic EDI tenders, you're most likely capturing blue chip shippers, most likely in the retail space. If you're seeing those kind of elevated volumes right now, you're not necessarily capturing kind of that representative slice of the market.
I don't think so, but I think APIs are starting to, they're not hitting EDI levels that I've seen yet, but they're getting there because it's so much more efficient. And we're seeing it more with a lot of vendors that'll do consolidators. So I think it's only going to be a trend that progresses.
Yeah, eventually blockchain, right? Once people figure out exactly what it is.
I'm not a big, after autonomous trucks, we'll get blockchain.
I had a question for you, Chris, about something that you said early when you were discussing, and that was talking about the difference between asset and non-asset-based carriers, how essentially non-asset-based carriers are effectively playing they're not playing a higher variance strategy. They're if you're a shipper and you go for a non-asset-based carrier, you're essentially just taking like this high beta play where there's much higher variance in the prices that you're going to get. And I guess I'm kind of curious, as a shipper, one of the things that I've heard from our shipper customers and talking to shippers is that cost control is so important. And so I guess I'm surprised that there's such a reliance on non-asset-based carriers when you're exposed to that much higher variance, especially since you're locking in rates on, under normal RFP season for like a year.
Yeah, it's you always have a mix, right? It's very few shippers that'll do 100% contract. They might try, but it doesn't end up that way. But then using brokers, back when I started in the mid-90s, contracting with a broker was a bad word, right? It was a 4-letter word, and so you stayed away. That's changed over the last 15 years. In fact, we've seen the percentage of freight going under brokerage versus direct to an asset-based carrier has, I want to say, more than doubled. We just saw that number last week. I'm trying to think what it was, but it's been increasing, and a lot of it is the brokers are much more sophisticated. Brokers can do certain things that asset-based carriers can't. They're drawing on much more volume. And so very sporadic lanes can be bundled by a broker. And on the average, they can manage that. An asset-based carrier is a little more challenged there. So I think they both have a role. And like I said, in a declining market, the brokers will be able to get lower rates on average. The asset-based carriers, since they're not procuring their services, they own the assets, they're more stable, but they're kind of set at their level. So it's a mix. It's a mix of where you want to use the brokers, and that's why we're trying to push the idea of a portfolio. You always have a portfolio starting from dedicated to some kind of contract to perhaps some kind of brokerage or spot at the very end. And so a mix is needed, I think, for any shipper of any size.
That's great advice, Chris. Even if you're a broker, right? I think understanding the kind of how you want to attack a year, like 21 right now, I know that a lot of brokers are thinking about being deliberate about their spot contract. because it's a direct reflection of how exposed they are. And, I mean, this isn't just trucking, right? It's if you're even a steel producer, you're going to lock in all of the individual components on spot and contract, right? Because you're not 100% sure of your production schedule. I remember this from the power industry. It's basically you're following a risk policy. It's easy for a Fortune 100 company to say, but if you're a mid-sized broker, you can definitely still take steps to be more deliberate. It's RFP strategy, how you respond to bids, what you're setting your margin at on the spot market to use that as a governor. I mean, there's tons of tactics you can use to affect that balance.
Yeah, brokers have a tough job because they're on both sides of the market, right? And so they're getting squeezed right now. If you look at the margins for brokers, because buying the carrier assets is increasing pretty dramatically where you need it, where the volume's appearing. And so, yeah, they've got a tough two-sided market problem. So it's a really interesting problem to dive into. I was actually just talking with my colleagues earlier this morning in China. We have a center there in Ningbo, and they're working with a carrier called TDH that has the exact same problem, trying to figure out that two-sided buy. So it's an interesting thing, and that's something where RateView and the tools that we have really help you make those decisions.
For sure. Well, we have a question. I'm going to read that, and then unless there are any other ones, I'm going to wrap up. So this one's from Jeffrey. Tender data may reflect repeat tenders driven by rejections as well. That's an interesting. I struggle with this as well, because without a unique load identifier, you don't really know how many rejections per load you're getting, right? I mean, I know it. In my prior life, we saw at times 75% rejection from our independent contractors. So that would look like, that would look a lot different if you didn't have the unique load identifiers, right? You would look like you had all these shipments, but in reality, you only had this many shipments, and only one out of every 4 response was an accept. Do you see anything like that, Dean or Chris, kind of on the shipper or carrier level?
I think it's an interesting. I think the answer is yes, because if you don't know the load identifier, you don't know which loads are being rejected multiple times on a lane because there's either no capacity or that hasn't been a rate set. So I think that's a definite possibility. I mean, the data still does give you an indication of which way the market's heading because, whether it's one rejection or that same load's been rejected multiple times, it's telling you something about capacity on that lane. So it's still a reasonably good indicator.
Yeah, it's still information. It's still information. And so if you have a lot of deep rejections, that chances are that's telling you the market's even worse. So I think showing that is a better indicator actually of just first rejections, because then you get a better sense of how deep people are having to go.
Is there any research, Chris, around once you've had 1 or 2 rejections, the odds that it makes it to the spot market, right? I know there's in other industries, there's a sense that.
Yeah, we had some capstone projects done with different shippers and carriers looking at that. And you can see, I mean, the rejection, as you go deeper in your routing guide, it goes up. And then the probability that it goes to spot, and this was a year ago. So, that changes with the market. But even in a roughly soft market, it was a 20 to 30% increase. But as the percentage that go through, that really differs shipper by shipper, because essentially the routing guide is like a net. And depending on how solid that net is built, a lot of things don't leave. Right, they get caught up in their alternates, but some have very loose nets and they go to spot really quickly. So it's really shipper dependent.
For sure. So I'm going to wrap us up. Before I do, Chris, do you mind letting folks know about the event that you have coming
Not
up
at all.
next
Let's
week?
go to that
one more time.
And so again, this is the event. It's next week at about this same day, Tuesday the 3rd, and it's going to be from 1 to 2:30 Eastern time. You have the link down there at the bottom. It's free. I encourage more the merrier to come. We'll have some interesting conversation. And again, it's focused on kind of that portfolio way of managing your transportation. How should you have contracts? So I'd love to have a lot of carriers there. I'd love to have some brokers in there as well, because then you can, add to the conversation. So I look forward to seeing you next week.
All right. So with that, I'm going to wrap us up and just remind everyone, dat.com/market update for all of Dean's treasure trove of information. We also have the Ask IQ at dat.com. You can reach out if you have any specific questions or would like a copy of our DAT Daily 50 lane report with Raycast. And lastly, we will be here next week at the same time to update everyone on what's going on in the market, and hopefully have another great conversation with our listeners. So with that, signing off for the week. Hope everyone has a great week. And if we don't catch you before the polls open next week, go vote.
Go vote.
All right.